It seems like it's just a waiting game as rates fall and the recession is inbound. Hi, this is Caden Ninny again, loan officer out of Phoenix, Arizona. Thank you again for hopping onto my channel for another mortgage rate and news update. And don't be afraid to hit that subscribe button and that like button so I can get pushed out to more people and you are not missing any one of my next videos. So let's jump right in. Not a lot of impactful news this week. Some things of kind of looking out into the future and forecasting. And we're going to dive into that. Overall, let's look at kind of what rates have done over this past week and really over the past 2 weeks. As you can see, following along with my cursor here, we have kind of been just bouncing back and forth here, sitting here for about 2 weeks. Reason being, we have a couple layers of support. I am a loan officer. I am not a mortgage rate analyst and economic analyst. If I was, I wouldn't be a loan officer. But based on everything I know, we're bouncing back and forth. We haven't had a lot of big news that would, be impactful positively and negatively, which is good. I'm okay with stability in my life right now when it comes to mortgage rates. We've been through a crazy last year. So let's take that stability as we see it. Again, another week where we didn't get a lot of news to try and break through one of these walls and maybe, green, for anyone who doesn't know, when we're looking at mortgage-backed securities and going up is a good thing. That means rates are coming down. So a lot of green over the past month, 2 months really, but we've just been bouncing back and forth, settling in, trying to see what this market's going to do. But I like this because if we can kind of keep some stability, we're going to slowly track down when it comes to rates. We may have a couple of spikes here and there depending on some reactionary news from investors, but overall, it is great to see that we're kind of settling in and trying to really see what's going to happen here. And we have some news here that might be able to tell us. So a couple things on the recession front. We had our first negative reading on hiring plans since the pandemic. We had the National Association of Business Economics. We had the 60 members. There was a survey. This was the first negative reading on hiring plans. That goes to show that their businesses are having less profit, and that means that they will need to cut overhead and people to continue to keep their profits and keep that business going. So when we have negative readings on hiring plans, hiring is gonna stop. They're gonna start to lay off people. This is a very clear indication of a recession, and the first one since we've seen of the pandemic. Unfortunately, these businesses are a lot of the reason that we had inflation in the first place. Now they're starting to see their profits dwindle, and now they may have to let people go. It is unfortunate, but when it comes to the housing market and interest rates, a recession typically is good because the housing market needs to be stimulated to continue purchasing, much like we saw in the pandemic. Pandemic was a recession leading into another one that was recession caused, or pandemic caused. But as for the housing market, this is what we would want to see. I don't want to see anyone lose their jobs, but when it comes to rates, we need to see recession kind of take hold here and really track down inflation. Next, we have the leading economic indicators. This is an index from the Conference Board, and they hit markers and give an index or a number based on how they're seeing the market going. We've seen the market, according to the leading economic indicators, on a decline for the last 10 months. And the forecast over the next 6 is we are leading right into a recession. And this leading economic indicators report is typically the front runner when it comes to indicating if there will be a recession. Heading out of that, we have mortgage applications. Oh my goodness, mortgage applications have been flying around since the start of the year. I think a lot of people just got into the new year, new me. And like I've said in past, 2 weeks ago, we had 25% increase in mortgage applications. And we've had 2 more consecutive weeks of positive application reports. This week, we're up 3%. Next, here's a big one. And, maybe specifically for loan officers and whatnot, but also helpful for any agents out there. The loan performance of existing loans. So this came from CoreLogic, and the report on loan performance was spectacular. We're still at record lows across the board on delinquencies and foreclosures. I wanted to specifically hone in on foreclosures because you typically have this population of people that say, I'm just waiting for all the foreclosures to hit the market, and I'm just going to swoop them all up. Well, that number right now is 0.3%. 0.3% of all mortgages and homes being owned right now are falling into foreclosure. 0.3%, not even a percent. we are not going to see this wave of foreclosures. That is not what's going to happen. We have a very low number. People can afford their homes compared to '08. We have put practices in place on the lending side that suggest, that say you can afford this much, and we're holding to that. People can qualify. People have equity. They have even more incentive to continue to make their payments on time because they have this insane amount of equity. So we are not going to see foreclosures hit the market. And lastly, today we had the PCE report come out, the personal consumer expenditure. One of the Fed's favorite inflationary reports, and it came in about as expected. We had it go up 0.1% month over month, but the most important number is that year over year as we replace larger numbers from last year when inflation was high. That number came in at 5%. It was a 0.5% decrease from last year, so it came in at 5%, and the expectation was 5.1%. So we came in right at expectation, even just a little below it, which was very good to see. It seems like the market, I'll even show you here, we'll drop back out. It even says, so points, or the 6 basis points up there in the top right, would suggest that rates moved up, but that 6 basis points is nothing. So it tells me the investors had already baked in what they wanted rates to be based on this report, of getting this expected report. So we're not seeing a lot of movement yet again, but very important to, very good to see inflation is still trending down. Like I said at the top, we want to just keep having inflation trend down. Rates will continue to drop with it, and it's going to be a slower drop versus the insane build we had last year. But ultimately, that's what I have for you. We're in a very good place. We just need to just keep putting wins together as we keep dropping these rates. Thank you for tuning in. Like I said, hit that subscribe button so you don't miss my video next Friday. Hit that like button, and I appreciate all the support. Take care.